Example of property and casualty insurance exam. Welcome to the quiz. What does jumbo risk refer to in insurance? Is it A, a risk with exceptionally high policy limits or loss potential? Or B, a risk involving elephants? C, a risk that is rejected by all insurers? Or D, a risk in the surplus lines market only? The answer is A. Jumbo risk describes an exposure with very large insurance limits or catastrophic loss potential, e.g., high-value buildings, major liability for large companies, mega yachts. These often require multiple insurers, reinsurance, or specialty placement due to capacity limits. Not animal-related. Not automatically rejected, though may go surplus. Not exclusively surplus. Jumbo means unusually large-scale or high-limit risks. Next question. What is the main purpose of business interruption business income insurance? Is it A, to replace net income lost and pay for ongoing expenses when a business must suspend operations due to a covered property loss? Or B, to interrupt business for renovations? C, to cover income lost due to poor economic conditions? Or D, to provide employee benefits during an interruption? The answer is A. A fire or other covered loss can force a business to close temporarily, causing lost revenue while expenses, rent, payroll, continue. Business income coverage, formerly business interruption, reimburses net income that would have been earned plus necessary continuing expenses during the period of restoration after a direct physical loss to covered property. It does not cover renovations, economic downturns, or employee benefits. The purpose is to restore the business financially to where it would have been without the interruption. Next question. What is typically required for a surplus lines insurer to write a policy? Is it A, the risk must be declined by 3 admitted insurers? Or B, the risk must be for a very low value? C, the agent must have a special license, but no specific risk requirements? Or D, the policy must be written for a 1-year term only? The answer is A. Surplus lines non-admitted. Insurers aren't licensed in the state, but can cover hard-to-place or unique risks through licensed surplus lines brokers when admitted. Standard insurers decline. Often, a certain number of declinations, like 3, from admitted carriers is required to prove no standard market exists. Low value isn't the issue. Agents/brokers need surplus lines authority. Term varies. Surplus lines fills gaps after admitted market rejections. Next question. What is the key function of a fiduciary bond? Is it A, to guarantee the honest performance of duty by a person handling another's money or property? Or B, to bond a company's financial officers? C, to serve as proof of workers' compensation insurance? Or D, to guarantee contract performance? The answer is A. Fiduciary bonds, also called probate, executor, administrator, guardian, or trustee bonds, are surety bonds that protect beneficiaries or estates when someone is appointed to manage money or property for others, e.g., executor of a will, guardian of a minor, trustee. The bond guarantees the fiduciary will perform duties honestly, faithfully, and according to law. If they steal, mismanage, or breach duty, the bond pays the harmed party up to the bond limit. It is not for company officers, that's D&O. Not workers' comp proof. Not contract performance, that's performance bond. Fiduciary bonds ensure integrity in handling others' assets. Next question. What is the main purpose of a certificate of insurance? Is it A, to provide evidence that an insurance policy is in force? Or B, to serve as a legally binding insurance contract? C, to replace the actual insurance policy? Or D, to guarantee claims will be paid? The answer is A. Certificates are summary documents issued to third parties, like landlords, clients, or lenders, showing key policy details, who is insured, coverages, limits, effective dates as proof that insurance exists and meets contract requirements. They aren't the policy itself, don't change terms, and aren't binding contracts or guarantees of payment. The certificate's main job is verification of coverage existence and basics for contractual proof. Next question. In inland marine insurance, what is a floater? Is it A, policy or endorsement that covers property that is mobile or in transit, often regardless of location? Or B, a policy that floats between different insurers? C, coverage for property that floats on water? Or D, an additional premium charge? The answer is A. Inland marine floaters provide coverage for movable, portable, or high-value property that travels or is used away from a fixed location, e.g., personal articles floaters, jewelry, cameras, contractors' equipment floaters, installation floaters. Coverage often applies worldwide or wherever the property is. Not switching insurers. Not literal floating on water, that's ocean marine hull. Not premium charge. Floaters insure mobile/transient property exposures. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.